welcome to mywealth.com. I'm Bob O'Brien. I'm one of the senior instructors with the courses, and welcome to the video blog for the day. Why the stock market rallied this week. Now, the market was up about 8% this week, and I want to go through with you not just the current events as to what created that rally, but also what creates trends in the market. Because I think it's really important, if you want to be a great investor, that you understand what creates the trends, even in the short term.
As always, make certain that you check out the written blog at www.mywealth.com/blog. Okay. Now, one of the things in the news that helped the stock market rally higher was that bank stocks rallied, and this led the market higher. Now, the bank stocks, they really couldn't go down much further. Citigroup was selling for under $1, and people took another look at it, and they felt that, that maybe they were just too pessimistic about stocks, bank stocks specifically, and they rallied. I'm sure you heard Citigroup, had some big days, and Bank of America as well, and this led the entire market higher. Okay. Reason number two, the bears got tired. The market basically just ran out of sellers, and this is referred to as a capitulation or a surrender in the market when you basically run out of sellers. Now, you could see this. This is a dynamic that occurs in a lot of markets. Take the real estate market, for example. When the bubble was formed, we had more buyers than sellers, and they were bidding up the prices on homes. Someone would put a house up on the market, and there would be 2 or 3 bids in the first day or week or so upon the house going up for sale. Now, that's not the case anymore. You have a lot more sellers than buyers in the market right now, and therefore the prices of the house, you're not getting bids, or the bids are coming in low, and that's therefore dropping the price of homes. So you see the same thing occur in all markets, and the stock market as well, except of course it's happening a lot more frequently in the course of a day as opposed to the real estate market, which is a much more slower moving market. Okay, this is the point that I want to spend the most time on. The short sellers covered their positions, and this drives the market up temporarily, and that's something that did happen this week. Okay, it's important that we understand short selling, and I know a lot of people don't completely understand this, and it is really important that we do understand this, and I just know from some of the questions in our courses and so forth. Short selling is something you do when you feel strongly that the price of something is going to go down. Okay, you feel a stock's going to go down, you want to enter a short sell. You can really do this for anything. In the written article, I use an example of like TVs and cars and so forth. But with stocks, it's done all the time because brokers are used to doing it, and essentially they use the title of stocks in order to do this. Okay, it's important that you understand the dynamics of this and how it works. So essentially you borrow something, and in the case of stocks, you're borrowing the title of stocks. You then sell it, you then buy it, and then of course you return it back to whom you borrowed it from. What's important to note here is that you sell first and then you buy it later. And of course that's the opposite of normal transactions. Normally you buy something and then you sell it. So let's put some numbers to this and take a look and see how you would make money if you were right. If something went down as you assumed it would, and how you would make money. Okay, so you borrow something and that doesn't really cost you any money. Okay, you then sell for, let's say, $100,000. So of course you borrowed it, you now sold it, and then you got to go back into the market and you have to buy it because you have to return it. And you were right, the price of it went down. It's now worth $75,000. You sold it for $100,000. You buy it for $75,000. You made $25,000. Okay. What's important to note as well is that in the course of doing that, you initially have to sell something which drives the market down. The sellers drive the market down by shorting something, and then they have to cover their positions, and that drives the market back up because they have to cover their positions, and it bids up the price of the stocks. Okay, and these are some of the things that we go through in our courses. We get more involved with technical analysis in our currency course, so you definitely want to check these out. So get in a course, get educated, get to www.mywealth.com.
Understanding what drives markets is really vital. And there's a lot of similarities, and that's why I'm always telling people that you need to understand at least 2 markets. just understanding one market alone is not enough, and it's very easy. You'll see a lot of similarities. Once you understand two, you're going to understand all of them, and that's what's going to make you a great investor. That's what's going to help you protect your money and make it grow at a reasonable rate of return, where again you're looking out for your downside. And that's what we're all about here at mywealth.com. Again, my name is Bob O'Brien. I'm one of the senior instructors with the courses. I look forward to seeing you in the course. Have a great day.